investing is not all about making gains. It's equally about preserving the value of your assets. A good portfolio is a combination of stable and volatile assets. Investments with the potential for high returns can be volatile and dip as much as they rally, making them risky. On the other hand, there are investments that are unlikely to make you money, but they protect you, especially in an adverse economy. In this video, we will explore some investments that can be a hedge against inflation or a recession. Whatever happens in the markets this year, your money would enjoy some level of security these assets provide. One investment that won't cost you money is subscribing to this channel. You will get returns and good financial content which we consistently upload. The first asset you should consider having is Series 1 savings bonds. These bonds are offered by the U.S. government and adjust for inflation, meaning that as prices rise, so does your bond's interest rate. Just as the name suggests, it is similar to having a savings account. But instead of fiat currency that's helpless against inflation, you have a bond that adjusts according to inflation, so you never lose your purchasing power. But how do these bonds work? They adjust their payments semi-annually based on the inflation rate. So if inflation is high, you'll receive a higher interest rate. And if inflation falls, so will your bond's payment. There are lots of good margins you can gain here, depending on the component of the economy that is driving inflation at the time. One of the best things about Series 1 bonds is that they are extremely low risk. They are backed by the government, meaning the government takes responsibility for the impact their policies make on your savings. However, it's important to note that if inflation falls, so will your bond's interest payment. You should not mind anyway because your purchasing power is being preserved in theory. Practically, you may find certain commodities or services not to be compatible with the inflation adjustment you were paid on, but generally, your money is not depreciated. If you are a beginner investor, this option is perfect for you. In the United States, you can buy directly from the Department of Treasuries. Other countries can consult their central banks for more information. Similar to this are exchange-traded funds and mutual funds that invest in government debt securities. These types of funds are considered low-risk instruments too. These options are better than keeping cash in the bank where it's losing value to inflation. Number 2. Treasury bills, notes, bonds, and tips. Most governments offer several securities in the form of treasuries. For example, the United States Treasury offers Treasury bonds, Treasury notes, Treasury bills, and Treasury inflation-protected securities, or TIPS. Treasury bills are short-term investments that mature in 1 year or less. They are considered highly liquid, meaning they can be easily bought and sold, which is good when you need to quickly convert your assets. Treasury notes are slightly longer-term investments, taking up to 10 years to reach maturity. This doesn't mean you're unable to sell before the 10 years, but just not at full interest if you do. Treasury bonds, as you can guess, are long-term, taking 30 years to mature. Treasury inflation-protected securities, TIPS, are unique in that the value of the instrument is linked to the rate of inflation, just like Series 1 savings bonds. One of the benefits of investing in Treasury securities is that they are generally considered low risk. If you hold the investment until maturity, you're unlikely to lose any money. However, if you sell the investment before maturity, its value would depend on the prevailing interest rate at the time, which is also determined by the inflation rate. Number 3. High-yield savings accounts. If you are interested in protecting your money from economic pressures, then a high-yield savings account could be just what you need. These accounts offer a higher interest rate than regular savings accounts, and they are usually insured by the government. In the United States, this insurance could be up to $250,000 per account. That means that even if the bank fails, your deposit would still be paid out to you with the interest. The advantage of this type of bank savings is the protection it offers against inflation. The interest rate is set very high, and it's likely always higher than the prevailing inflation rate. However, it's important to keep in mind that there are still risks involved with high-yield savings accounts. Inflation can get very high and overtake the interest rate you're going to get on your money. In this case, your money is losing its purchasing power, but even in instances where inflation rates get very high, these high-yield savings would still provide some restitution for the owner. Besides the protection they offer, you are also able to quickly access your funds when you need them. To minimize this risk, you have to check the interest rates banks are offering and decide which is best for you. Proper research can help you discover very high interest rate offers. Number 4. Dividend-paying stocks. When investing in the stock market, it's always important to consider the possibility of a recession. The multiple bear market dips and rallies staged by the U.S. stocks in 2022 suggested that many investors had not fully embraced the likelihood of a slowing economy and higher interest rates. We are likely to see this continue this year, but don't lose hope just yet. Dividend-paying stocks are a great option if you want a stock investment that is safer. These stocks pay cash dividends, which helps to limit their volatility and give you some return regardless of how the stock valuation plummets. What sets dividend-paying stocks apart from other types of stocks? For starters, the issuing companies tend to be more stable and mature. They also offer the added benefit of regular income in addition to the possibility of stock price appreciation. So it's a double win for you. But of course, no investment is completely risk-free. One risk for dividend stocks is if the company runs into financial trouble and is forced to cut or eliminate its dividends, which could hurt the stock price. The fifth asset you should be considering is fixed annuities. Annuities are contracts made with insurance companies that can guarantee a certain level of income for a certain period in exchange for an upfront payment. There are a variety of ways to structure an annuity, such as paying over a fixed period of time, such as 20 years, or until the client dies. Payments can also be planned towards retirement. A fixed annuity provides greater financial security during periods when you are not working by providing a guaranteed income and return. A minimum guaranteed payout or death benefit may also be included with some annuities. It's important to remember, however, that annuity contracts can be complex, and you should read the fine print carefully. They are also illiquid, so getting out of one can incur significant penalties. Your guaranteed payout may not be as attractive if inflation increases significantly in the future. The sixth investment hedge: real estate and REITs. A real estate investment trust, or REIT, is a company that owns income-producing real estate which is sold just like equities. The benefit of investing in real estate and REITs are numerous. For one, both options offer tangible assets that can appreciate in value over time. Additionally, REITs can provide a steady stream of income through rental properties. Real estate is a great option for long-term investors who have the means for a down payment and related costs. But for those who want to skip the hassle of property management, REITs, or real estate investment trusts, offer the opportunity to invest in a pool of properties without owning the physical property yourself. But as with any investment, there are risks to consider. Inflation rates can have a significant impact on the housing market and on household expenses such as repairs and maintenance. It is possible to reduce these risks and make informed decisions by working with a reputable real estate broker or investing in publicly traded REITs. The seventh and final investment hedge is gold. As we saw in 2022, gold was a strong performer compared to the stock market. Despite the fact that many investors complain that the price of gold has been stuck for many years, the Spider Gold Trust, or GLD, was only down 0.8% for the year, while the S&P 500 saw a decline of 18.11%, and the U.S. stock market lost 19.9% last year overall. This is evidence that gold still does a good job of protecting your investment. Historically, gold has been one of the most popular safe havens for investors, and a great hedge against inflation. In fact, gold has an annual average return of 0.4% in the last month of 2022, and has already gained over 6% in 2023. With the economy and US dollar weakening, we expect gold prices to remain elevated this year. So how can you invest in gold? One popular option is the GLD ETF, which gives you exposure to the commodity itself, but it's important to avoid the stocks of individual gold mining companies or a gold mining ETF like GDX. This can come with more volatility and risk, despite the potential for huge returns. And here are some bonus tips that could help. First, it's important to understand that even the best companies may not perform as well as expected this year. Analysts have already reduced their expectations for a number of sectors in the coming year as a result of the lingering effects of high inflation on the financials of companies. As a result, we may not see the stock prices rise as much as we would like them to. We may have to wait much longer before we see a rebound in the stock market. It is important to be patient. But what about the here and now? How do we protect our investments in the present? The answer is simple: diversification. As a wise investor, it's important to spread your investments across a variety of different assets. If one type of investment underperforms, you've got others to fall back on. This video is given some tips which cut across different asset classes. This way, you always have one group of assets covering the losses in other investments. So there you have it. The key to weathering a tough economy is patience and diversification. By spreading your investments across a variety of different assets, you can protect yourself from market volatility and come out ahead. So don't wait any longer. Start diversifying your portfolio today. If you like this video, hit the like button and subscribe for more. Do check other related videos on the channel.